Hello, everyone. Welcome to the Saturday stream on Elevate Your Equity and the Saturday stream on the Facebook Tribe and also on YouTube. It's great to see you guys and hope you're having a fantastic Saturday, getting ready to have an awesome weekend heading into February 2021. Today, I wanted to talk about something that's very near and dear to my heart. It has to do with macroeconomics. And even though I'm not a macroeconomics professional, I have been talking with lots of economics and experts in their field, and I wanted to share some of the insights that I've been gaining from them, because it's really, really important no matter what you're doing with your investing. If you want to get an advantage, you got to understand where the winds are blowing in the overall economic situation so that you can win over the long term, okay? And today I want to talk about currency risk and inflation and how that translates to whether you're investing in stocks or bonds or real estate or something else, right? One thing to really keep in mind is that inflation is something that's very real. It has been happening constantly over the last couple of years, and actually since the Fed was established in 1913. So we really have to be aware of these monetary controls on our money supply. There's all kinds of other weird influences as well that's going on right now as we're recording this video. The COVID pandemic is kind of really throwing things up in the air and kind of like, reorganizing what we think about modern monetary policy and what we're doing as investors. And understanding how investors can take advantage of that or get harmed from it is going to be really important. So really what I want to do is talk about currency risk as well and how strong the dollar has been, and maybe if it's losing power or recognition in the world stage, that might be something for us to think about as we're going through our investing, right? So maybe I'll just start back all the way at the beginning, right? You probably haven't thought about it, but what is the dollar and how healthy is the US dollar right now? Well, it turns out that the US dollar is actually still pretty strong. There's a lot of people that think that it might be actually weak, but it is a pretty weak, shaky currency right now because it's fiat. It's not based on anything that has to do with anything tangible. That Nixon back in the 70s, I believe, removed us from the gold standard. So all of the dollars printed are just based on blind faith. There's nowhere that you can go to turn a dollar in and get a dollar worth of gold back out that's set by the US government or set in any specific way. Right now, it's all just market driven. So when more dollars are printed, that same ounce of gold or same amount of quantity of things will go up in value just because the amount of the dollar is worth less, okay? So for those of you out there that are holding lots and lots of cash in your bank account, there's some advantages to that, but I wouldn't count on the US dollar as being something that you can hold on to preserve your wealth. And you'll see what I mean here in just a little bit. What I would like to do is I would like to show you an image from my book that kind of helps describe what the effect that I'm talking about. So let me share my screen with you. I'm going to show this side over here. And so now you should see an image from my book that actually was pulled from online at howmuch.net. This has been super, super helpful to help describe what's been happening to the spending power of the US dollar. It shows that in 1913, the same $1 today, or about $5 today, it was worth about $100 back in 1913 when the Fed was created. And you can kind of see what inflation has done to the value of a $100 bill over time. And so that same $100 bill back then in 1913 could buy you a whole lot more than it could right now in 2019. So I thought this was a really, really well done way to kind of explain how inflation works and what has happened through each of the US recessionary periods, right? So this is super important. And I just really want to make sure that you guys are aware that there is data out there that shows that the dollar is losing spending power over time. And when we're going through investing, we got to keep that in mind and maybe even use that for our advantage, okay? So the other thing that I wanted to talk about was the world's reserve currency status, okay? So what that means is that over time, all of these countries, like these third world countries and even some of the modern rising powers, in order to trade internationally, they like to exchange money in either one country or the others, or a global currency that's recognized as being a standard of stability, right? And many times in the past, it used to be the Dutch, it used to be the British pound, and now it's the US dollar, right? But you notice that it used to be the Dutch, I think it was kroner, I can't remember exactly what that was. But there was that. Then there was the British pound, which that obviously faded away too once the rise of the United States came on in World War I and World War II. And then now it's the US dollar. But that also may potentially have an end as well. We'll talk about that a little bit later on. But essentially, what's called the world reserve currency status. That means that everyone recognizes this currency as something that's stable and can be internationally traded. There's faith that if one country trades with another, even though that reserve currency, like the United States, isn't involved, like for instance, if Afghanistan is trading with, I don't know, Turks and Caicos, right? Let's say there's some sort of trade deal there. They may not trust each other's economy, so they put faith in the US dollar. And so they trade using US dollars. And so a lot of commodities like oil and gold and things around the world are traded with that US dollar. And because that global currency is the global system is run by the US dollar, when we print dollars here in the United States, that printing effect and the weakening of the dollar is spread across the entire world, right? And not just kept local to the country. So that means that we have such a huge advantage, right? Now, unfortunately, here's the next slide that I want to show you. The amount of dollars that are being used as global reserve currency is starting to slowly decline. If you look at a graph from the IMF and you look at data previously from 1970 all the way to now, there was a point where the world reserve currency status dropped down to like 45%, but then it's recently climbed back up to 66. Either way, I think that this is a strong indication that the world is trusting the US dollar a little bit less, which means that they'll probably end up trading in either their own currencies or something else. So when we print dollars, right, we're going to feel the effect more here in the United States rather than having the productive energies of the dollar being transacted around the world, okay? So what that means is that the inflation effect is going to be taking off a lot more if the global reserve currencies don't end up trailing back up. At least that's what I've been hearing from some of the economics out there, okay? And this means that if the dollar is cheaper, if the dollar costs less, then that is a good thing for the economy right now. Because as the dollar is less, it's easier to transact internationally. And so right now, the entire world wants cheaper dollars, and the US wants it as well, because that means that trade can pick up and there's more stimulus to trade and start businesses and things like that, okay? So that's something that I wanted to share with you as well. This is what I was talking about earlier before. We did dip down to about 46% back in the 90s. So I take that back, not the 70s. The 70s, we were at a peak. And then in the 90s, we dripped down to 46%. Then euro comes in around 2000. And then so we've been pretty steady at this point, but we've been dropping pretty consistently over the last couple of years because of the pandemic and some of the global fears that we've been having, okay? So I thought that I would just share that with you. Again, interest rates and global reserve status and inflation, these are all things that we really should be aware of and just kind of have an idea or be conscious of these effects in the overall economy, right? So that we can make our moves as investors, okay? And so, yeah, this is also a little bit that I wanted to highlight on what's going on with the central bank and what kind of money we are printing. It's just been insane amounts of year-on-year change. Obviously, we're printing all this money to provide stimulus for people that need it. And so we're kind of taking advantage of our current global reserve status and spreading all of those printing of dollars across the entire world, but the US is getting the benefit of it. So other countries are starting to catch on to that. So that's why I think that, over time, they're going to recognize that other countries are subsidizing our subsidies going out to the stimulus checks across the United States. And so that's something that may start to instill a little bit of mistrust in the US system, which means that people want to transact less in dollars, which means that in the US, when we print more money, we're going to feel it here harder at home, okay? So that's what I wanted to convey there too. This we'll get into a little bit later, but because it's pretty interesting there. But what I'm going to do is I'm going to stop the screen share and come back to you. So what should investors look at right now, right? How should we adjust our perspective on gaining wealth? I think that it's always good to invest in things that have strong demand. So regardless of whatever's happening with the economy or with the money supply itself on the supply side, if you're investing in assets that are always in demand, and right now, because population is increasing around the world, I think that real estate is a very strong place to put some of your hard-earned cash right now. Couple that with the fact that you'll be partnering up with the Fed and the government by taking advantage of inflation, because when you buy assets right now at a fixed debt rate that's historically never been lower, by the way, you're borrowing dollars at today's dollars. And as you go forward in the future, your income will go up with inflation, right? But the dollars that you put on as debt is fixed. So the debt that you're going to be paying with much cheaper dollars later on, right? If you get real estate in your asset bubble and in your portfolio. I do want to also mention one story too. My grandfather, I remember back in the 90s, I think, I remember going to his house, and I remember like talking a little bit and hearing a little bit about money and seeing what I was very young. I think I was like 10 or 12 at the time. But I remember going into my grandpa's office in his house in Southern California. And my mom and my dad were kind of like having a heated exchange back and forth with my grandfather, because when I went in there, I saw mounds of cash inside the house. And I really never forgot that, because it's pretty cool to see all of that cash, especially when you're so young and a dollar means so much back in the 90s. But seeing all that cash really kind of stuck with me. And I've always had that in my mind that was what I wanted to do. I wanted to be able to save up so much cash, right? And just like have that mountain of cash as like security, or like, be able to spend it however I want to. The truth is, though, is that was a terrible, terrible investment. And I only learned that later on, because, it's always been in the back of my mind. But, now thinking about it, keeping that much cash or that much faith in the U.S. system, whenever you hold dollars, you're keeping faith in the U.S. system. That's the only thing that's propping up the value of the dollar. The value of the dollar is being propped up by the ability for someone else to recognize the value and trust that value is still there. Okay. So putting that much trust in the US dollar is way too risky for me. So it's kind of weird to say it, but having mounds and mounds of cash is very, very risky from a macroeconomic perspective, and also from a physical perspective. If someone finds out that you have all that cash at home, then just don't be broadcasting that out. You know what I mean? But if your money is spread out across assets and it's working and it's effectively being employed, then that's the best way to kind of keep your money being effective, instead of sitting in your house as cash. Okay. So I just thought I would share that story, because it was very powerful for me, and it's something that I will never, ever forget. So again, I would really strongly consider that you look at buying assets. Now, I wanted to go back to sharing the screen once more, because there's a lot of options out there in the market right now. And I thought that was really cool a couple of days ago. And so I'm not sure when you're watching this, whether it's live or it'll be in the future in the end of January in 2021. But we just found out that GameStop had been completely gamed. There's a whole bunch of hedge funds that had bought GameStop stock on a put option, or some sort of option that if the price goes down, then they profit from it, right? So there's a bunch of Redditors that kind of came together and basically said, you know what, let's just buy a whole bunch of GameStop stock and shove up the price and stick it to the man, which would be these hedge funds. And they did. It went up like crazy. And I'm going to show you what that actually looked like. And very, very cool stuff here. Let me see. Let me share the screen. All right, so here was the old photo that I showed you before. Here's what happened to GameStop stock. Look at it. It was all the way down to like maybe $5 a share or something, right? And the beginning of the year, $5 to $10 a share, right? And look at it, it's over $100 a share now, and I think it's still going up right now. And this is just absolutely insane, right? So would you want to put your faith in this system? I don't know. I mean, I'm just saying right now that there's a lot of change going on, and the stock market is artificially high. And so for me, I think that putting money into the stock market may not be the best solution, at least for me, because I maybe don't know it as much as I know real estate. So I think that this is something that you should be aware of, right? Is that you have kind of there is some control here that's very unusual. But if you're on the other end and you've bought some of those hedge funds, you're going to be on the losing end of this thing, right? And so it's very volatile, very hard to control, and you don't have very much control in general on this. So that's something that I would strongly consider thinking about, is that instead of buying stocks, try finding alternate investments, like maybe businesses or perhaps even real estate. That's always something that has done really well for me. Okay. So last thing that I wanted to talk about is demand, right? And what investments we could go with. And also, sorry, I wanted to back up again one more time. I wanted to talk about historically and macroeconomically what some smart people are saying about what's going on with the overall economic situation. Again, I'm not saying this is like, definitive and completely authoritative, but I do want to show you what some of the greatest minds in the US are thinking right now. This is from, if you guys are part of LinkedIn, this is from Ray Dalio's LinkedIn articles, and he's been writing a lot about what he's seeing in the economy based on his knowledge from running Bridgewater and Associates. It's a huge hedge fund, and he knows the market very well. And he is also has an extremely good book out there called Principles, which I recommend anyone read. And he's a very wise person. I respect his opinion a lot. And what he's noticing is that over time, from the Chinese, the Dutch, and the English Empire, and now the United States Empire, they all follow this type of progression over time, right? There's some sort of world change where a new world power comes in. And for us, that was around World War I, World War II, where the United States was extremely productive, very peaceful, and had lots and lots of productive debt growth, which meant people were taking out loans to invest in businesses, and they were doing well. They were making profits, so they were able to grow and become entrepreneurs, right? And we had a great middle class that was very effective and just prospering. Then, of course, over time, we start having this big debt bubble, right? Like, eventually we start outsourcing all of our work, right? And so we're taking out loans to let someone else do the work for us and just kind of riding the winds of what we feel is healthy debt, right? And then eventually there's all kinds of, more and more debt that's going. Then we'll have revolutions and wars. Then we'll have debt and political restructuring. And then there'll be a new world power that kind of replaces the old one that has been going through all of this craziness, right? And I hate to say it right now, but I am starting to see some patterns happening with printing and money and credit. And so I think that the United States is probably somewhere in this area right now. I don't know exactly where and how long it's going to take. The good news is that normally these cycles last about 80 to 100 years, right? They kind of correspond with the long-term debt cycle that Ray Dalio talks about in his book. And so I think this is something that's really important to talk about, okay? So again, I'm not claiming anything here, but I do definitely think that the United States was a much different place when I was growing up. And I think that we are probably somewhere in this downward trend. And depending on your age, we may end up seeing a new world power coming in that starts overtaking the US in world reserve currency status, and also in just overall recognition of world, like the major world dominant power, okay? So that's just what I'm kind of seeing right now. I hope it's not kind of a downer for you guys, but here's a little bit more data from his LinkedIn article. You can see that the Netherlands, they had their peak, and then the United Kingdom had their peak, and then the US is having their peak. And then you have China that's also increasing. And I would encourage you to go in and look at this article. And if you want, go ahead and make a comment in the comment section of wherever you're watching this, whether it's YouTube or on Facebook. And I would love to provide you the article, a link to the article in LinkedIn so you can read it for itself. But this relative power to other empires is based on a whole bunch of different factors. And it is actually right here. You have competitiveness, output, education, military, financial, innovation, technology, trade, and the world reserve status, right? And so you can kind of see right now that education was a huge part of the beginning of the boom, because that helped produce more productive people when the US was ready to start popping, right? When they were ready to start popping in like the early 1900s to now. And so that created a whole bunch of really strong-willed independent people, independent thinkers. And over time, we're starting to lose that advantage because our education is kind of going down. Like, we're actually rated in the lowest tier of education in the country or in the world right now. But you can see our world reserve status is kind of keeping us in terms of power. You have innovation and technology that's still up there, driven by the cheap debt and just the go-get-itness culture of the United States. But I would be really cautious to kind of start to watch what happens with this, because if you look at the article, all of the countries that had previous empire states, they had this sort of same type of layout, and it only took about 80 to 100 years from their peak of power, which is somewhere in here in the early, which is about from the early start of their peak of power to the end. It's about 80 to 100 years, which is coming up pretty close. So I just thought I would go ahead and share that with you, and it's good to be aware of this, that potentially later on it may be hard to obtain assets. So I just wanted to highlight that. Okay, let me take off the screen sharing. So that being said, I don't want you guys to be fearful or afraid of what's coming in the future. Just know that there's going to be winds of change coming. There always is, right? I mean, who would have thought a year ago that we'd be shutting down the entire economy in 2019 and 2020? And it's a massive shift. And those kind of things can happen going forward. So I would encourage you to think about the strength of the dollar, right? So whatever you're investing in and anything that you are putting your faith in, just be careful. Make sure that you're watching the higher economic forces taking place, and start to think about how to partner with them. It's much better to swim along with the stream than to swim upstream. Okay, and so I'm just asking you to consider that a little bit more, and just make smart investment decisions. Make sure you understand that the dollar is not always going to be the strong dollar that it is. So please start pursuing assets that have strong demand, so that you can buy assets and then you can refinance or pull out money from them or sell them in any currency. Okay, that's my advice. So that being said, you guys, I think I'm going to go ahead and put a pin in the Saturday stream. But if you want to hear more, please join our Facebook group. You can just go in. It's called Elevate Equity Tribe. You should be able to search for it. And there's a few membership questions, and then I can let you in, and you'll have exclusive access to a bunch of content that I've been sharing with just my individuals, my close peeps. And then you can also look me up on LinkedIn. And we also have a book called Part-Time Real Estate Investing for Full-Time Professionals. It's actually right there. You can see it. It's a pretty awesome book. I really am proud of this thing. And it's meant for W-2 working professionals who don't know how to start investing in real estate, whether it's single family or multifamily. I've got it all here for you while you're working a full-time job, and how I was able to do it to build a portfolio while working out of state. And then we have podcasts as well. Elevate Your Equity podcast, where my wife and I, we interview some of the experts that have raised hundreds of millions of dollars, and kind of break out what it is that happened in their personal lives at home, and so that you can walk with them through that process and maybe follow in their footsteps. And so we enjoy doing it, and we just hope that you guys are getting so much value from all of our content. Please go to my website as well, elevateequity.org, and you can sign up to get newsletters from us, more information. There's blogs, and then we'll put all of our podcasts in video and audio form there as well for you. And we also have coaching if you want to try to take your investing to the next level. We're here for you. All right. So that being said, you guys, that's all I got, and hope you guys have a fantastic weekend. Enjoy, and stay tuned next weekend, because we may do a deep dive on the 36 unit that we're actually under contract now and going to be flying out for in the next couple of days to do some inspection walks and take pictures and do the due diligence. So if you want to follow along with that process, we probably will end up doing a shotgun Saturday stream for that one, just on how it all works. And we're excited to share all of that with you. All right, I've taken up enough of your Saturday morning. Go have an awesome weekend. Enjoy, and we will see you back next week. Take care, everyone.